Aloha, my name is Kevin Kimball, and the purpose of this video is to help you learn how to track the life of a simple business, or this could be referred to as Accounting 101. To start off, let's have you meet our entrepreneur. This is Spencer. Spencer's a good kid. Spencer would like to raise money for his mission. He's even thought that he might serve in Berlin like his father did. But where to get the money for a mission? Based on extensive market analysis, Spencer discovered a great market niche for straw hats. He might even be Hawaii Straw Hat Company's top hat model. In fact, that's the name he might call his company, Hawaii Straw Hat Company. He's thinking maybe he could even model the straw hats that he buys. But where to get the money to get started? He knows he needs some money, cash, to buy the things that he needs to run his business. He might need some inventory which he plans to sell to customers. He might need shelving to put the inventory on. He might need a computer to keep track of everything that's going on in his business financially. And so he's simply wondering, where can he get the money? One idea he's had is that maybe he could break into his piggy bank and contribute that money into his company and use that to get going. Another place he might get it is he might get money from his dad. His dad could act as a lender or as an investor. Now, if his dad lends the money to Spencer, Spencer's going to have to pay it back with interest. That's called temporary financing. But if his dad becomes an investor, maybe a partner with Spencer, then he becomes a part owner, and therefore Spencer would not have to pay that money back in any specific period of time. That's called permanent financing. So if the dad lends money, so effectively Spencer borrows it, that's temporary financing and needs to be paid back with interest. If he invests as a partner, then under their partner agreement they would decide how those monies would ever be paid back. Maybe it would be upon liquidation of the company, or maybe there's a certain time frame at which the partnership would dissolve, or something like that. But usually they become partners and they stay partners for quite a long time, and therefore there's no specific time frame in which the monies would be paid back. So his dad could lend money or become an investor. Spencer could also go to the bank or to other lending sources to borrow money. Once again, that would be temporary financing. So let's think about how the business financials work, specifically the balance sheet. If you imagine a balance in the olden days, what you'd use is a balance. On one side you'd put weights that you knew the specific measurement of, and on the other side you'd put whatever the person was buying, maybe it were rice or gold or whatever it was. And once they balanced evenly, then you knew that whatever was being purchased was exactly the weight that was in the other side. So on this side, let's call this our assets. These are those things that the company has, the resources that the company uses to run the business. These are things that are going to benefit the company in the future. Now, on the other side, to kind of balance this out, you have the liabilities, which are the borrowings from the bank, borrowings from dad. And then you have equity. This is how much of these assets belong to the owners. So for example, if you took these assets and deducted the amounts that were owed to the people that you borrowed from, then what would be left over is the equity. And you've probably heard that term when people talk about their houses. They say, I have $500,000 of equity in my home. That means if they take the home, let's say it's $700,000, and deduct the liability, which is $200,000, they would be left with $500,000 of equity. What this does on the right hand side is it explains where these assets came from. How did you get it? So what do you have, and how did you get it? These always must be in balance. In fact, they are always in balance, or should always be in balance, just mathematically, because there's an equation: assets equal liabilities and equity, and it's true by definition. So if your assets didn't come from liabilities, then they must have come from the owners. So let's talk about HSHC, and how it gets started. On January 1st, 2011, Spencer invests $51 of his own piggy bank money into Hawaiian Straw Hat Company, thereby obtaining 100% ownership. Why? Because he put in assets of $51, and then he has to explain where he got those assets. Did he get those assets by borrowing from someone? No, he didn't. And therefore, if you take these assets minus the liabilities by deducting liabilities from both sides, you'd get assets minus liabilities would equal Spencer's equity of $51, and we're in balance, and the owner of all that is Spencer. Now, just going back for a second, what I'm going to do for each of these transactions, I will then create a little video numbered to match this that will show you how to create this transaction in QuickBooks. So I'm showing you what happened, and then I'll do a little QuickBooks video and slide it in here, or at least refer you to that where you can watch how to record this transaction in QuickBooks. So just remember that after each of these slides and transactions, there will be a correlating QuickBooks video to help you learn how to record that. Next, HSHC receives a secondary investment. On January 2nd, Spencer's dad invests $49 into HSHC and receives 49% ownership. Now you might want to ask yourself, why would it be $49? Let's look at it. Carried forward from the last slide, you see that we still have the assets from Spencer, the cash, and his equity. That's what's carried forward. But then Dad comes in, and he contributes $49 of cash, and therefore assets are $100. Well, how did we get these assets of $100? We already know 51 came from equity of Spencer contributing. We know that we didn't get this $49 by borrowing because we just said Dad invested it, and therefore this additional increase in assets must have come from equity, and that equity being from Dad. So now Spencer's a 51% owner because you take 51 divided by 100, and Dad is a 49% owner. You might want to wonder why Spencer kept 51%. Well, he kept 51% because if this were like a corporation, that 51% would mean he has the majority controlling voting interest in this company. And maybe he just wants to ensure that his dad realizes, hey, this is my company. But anyway, that's what he did. So then you'd refer over to QuickBooks and watch how this transaction is recorded, but let's move on. HSHC borrows money from the bank. So on February 1st, HSHC borrows $200 from LIEA International Bank for 1 year at 10% compounding monthly. And I know you already understand those principles as to how that compounding works, and so let's go ahead and record this. Carried forward, I'm just bringing this from the last slide forward, the total assets and total equity. But we get in $200, and therefore our assets are now $300. That's what we have. Now the next question is, where did this come from? Did we get any of this $200 from liabilities? And the answer is we did. These are borrowings, and therefore our total liabilities are now $200, and no change in equity, because if all the assets were increased simply by liabilities, then there would be no increase in equity, and we stay in balance. So you should see this always remains, whatever is on this side will always add up and match this on the other side. If that doesn't happen, then you know you got a problem, because it has to. Next, HSHC creates a purchase order. What a purchase order is where you contact your vendor and say, I'd like the X amount of this product, and could you please send it in a certain time frame? And so that's what's happened here. HSHC creates and sends a purchase order to China Hat Company, its vendor, to purchase 100 hats at 50 cents per hat. So you know the initial cost will be 50 cents per hat, but you know that it'll also have to be shipped, and there may also be sales tax involved or other duties or things. Carrying forward from last slide, we have the assets of 300, liabilities of 200, and equity of 100. And then we say, okay, is this a financial transaction? All we did is we created a purchase order and we sent it. Did we receive anything of value? No. Did we commit where we have to pay? anything of value? No, we didn't. We would like it, but since we haven't received the goods yet, there is no current effect on Spencer's balance sheet, its income statement, or its cash flows. So you got to be a little careful. In this instance, there is no current effect on the financials. All it is saying it's a request to receive inventory. Since we haven't received it yet, we do not have control over it, there is no financial statement effect. But we will record the purchase order in QuickBooks so we don't forget about it, so that we can document that it was authorized, and so that when we receive the goods, we can refer to this order, and it actually makes things go a little bit faster. So let's move on. So no transaction on the financials, but we will go to QuickBooks, so make sure you go to QuickBooks, or the tutorial video, to watch how to record a purchase order. Next, CHC delivers the hats to 10 net 30. What this means is if Spencer pays in 10 days, he'll get a 2% discount on the price. Now, if he doesn't pay any amounts within 10 days, then the full amount is due within 30 days. That's how you read that, and you'll learn more about that in Accounting 201. Next, CHC delivers 100 hats, and their invoice number, it's their way of referring to this particular sale, is number 452, and we will use that in QuickBooks. The total invoice amount is $60, as follows. $50 is for the hats. Remember, it's 100 hats times 50 cents, so it's $50 for the hats, but we had to pay $7 for shipping and $3 sales tax. But when everything's said and done, these hats have cost us 60 cents per hat, and that's what we're going to put into our inventory assets. Carrying forward from our prior slides, we have our assets, liabilities, and equity, but then we bring in $60 of an asset. This asset is called inventory. So we bring in $60 of inventory, and that's a resource that we will use to hopefully make sales later. And so our total assets are $360. Now we have to ask ourselves, how did we get this $60? Did owners contribute the $60? No. Have we already paid it by reducing cash? No, because all they did was deliver it. We haven't paid for it yet. And therefore, we have a liability. So as we have more assets, since we haven't paid for it yet, we owe the money, and therefore we have a liability of 60, which increases our liabilities to 260. No change in equity. Why? Because we haven't paid for it, and also we haven't sold it. Now, if we had paid for it, all that would have done is reduced our liabilities and reduced our assets. So even paying for it wouldn't impact our equity. Moving on. HSHC sells 10 hats for $21 on account. On account means you sell them to the customer today, but the customer may not pay until later. So this is on February 17th. HSHC sells 10 hats on account to Ali'i Turf for $21. $20 is the sales price plus $1 sales tax. The 10 hats cost $6. So what we're saying is our final price to the customer is $20. We have to pay. We'll have to charge them also $1 sales tax, which we will then give to the government. But these hats that we're selling for $21 only cost us $6. So you can see there's going to be a margin between the $20 sales price and the $6 cost of goods sold. And that's where you get the math. $60 divided by 100 hats times 10 hats sold, $6. So now this one's a little trickier because it actually comes in two pieces. We'll talk about what we're hoping to get paid and the impact on the financials. Then we'll talk about the cost of giving up the inventory. Carrying forward our prior assets, liabilities, and equity. That's our starting point. And then we bring in assets of $21. $21 is this right here. Now the customer has not paid us yet, so this is not $21 of cash. It's a $21 that the customer owes us. So since they're owing us, it's our asset, and we call that an account receivable. So an account receivable from customers, $21. Now how did we get this $21 asset? Well, one of it is going to be a liability to the state, because of this $21 we owe $1 to the state government. Now the other $20 will increase our equity in the company. Spencer's and his dad's equity in the company. This would be a revenue, so there'd be another statement called an income statement. On that you'd show $20 of revenue, which would then increase your net income, and net income increases equity. So in other words, if assets go up because you make sales to customers, equity can go up. Now, as you know, we didn't just get $21, we also had to give something up. What did we give up? We gave up $6 of an asset called inventory. So we have to reduce our assets over here. We have to reduce these assets by $6 because we went into the inventory warehouse and took out $6 of inventory and gave it to a customer. So our assets have gone down 6. Now on the other side, we have to say, well, why? Let me go up one. Why did our asset go down? Remember we talked about how did we get the assets? Well, we also might want to know how we lost the asset. Did we lose the asset because we paid off a liability? No, that's not it. Did we lose the asset because our owner's equity went down? Well, the answer is yes, because we've recorded an expense of $6. Expenses reduce owner's equity. Revenues, as you see here, increase equity. Expenses decrease equity. So on the income statement, we would show a $6 expense. So the expense is going up on the income statement, but as expenses go up on the income statement, income goes down, and therefore equity goes down. So what's our new balance sheet? We have $375 in assets, $261 in liabilities, and $114 in equity. And if you add these up, you should see that this adds, liabilities and equity adds to $375 of assets. Number 7, HSHC writes a check to pay CHC for the 100 hats it purchased on February 15th. So you remember, HSC bought these hats and then planned to pay later. So they purchased on 2/15, and if you pay within 10 days, you're going to get a discount. Well, let's see what happened. HSC paid on 2/27. Is that within 10 days? No, it's not, and therefore HSC does not get the discount. HSC writes check number 1 to pay off the $60 invoice. He has to pay the full $60. Now, if he had paid within 10 days, he could have taken a 2% off of this price and only paid the difference. So that would have been 2% of 60, which would have been a $1.20 reduction, and so you'd only have to pay $58.80. Okay, moving on. So carrying forward our assets and liabilities and equity, we're just lumping them all together here, but you'll notice on an actual balance sheet that this will be broken up into cash and inventory and accounts receivable, and we'll get to that in QuickBooks. But this is carry forward, and then we write the check of $60. Well, if we write a check out of our cash of $60, what will happen to our assets? They'll go down. Okay, so our assets do go down. Now, why did our assets go down? Well, they went down because we paid off a liability over here. So let's finish up assets, 315, but then you'll see liabilities went down, and we're back to 201. Remember, this 201 is $200 owing to the bank and a dollar sales tax to the state government. Now, does this payment impact equity? When we pay off for the inventory, does it affect equity? And the answer is no, because we've already explained why the $60 asset went down. It went down because we're paying off a liability, and therefore it already balances, and therefore no change over in equity, and this still stays in balance. HSHC receives a check from Elite Turf, so now Elite Turf actually pays for the inventory they bought. Remember, we've already recorded the revenue. We've already impacted equity for the $21 sale. So all we're doing now is collecting the cash, and that's a very important difference. We're using what's called accrual basis accounting, and we are simply recording the receipt of cash which someone owed us in the accounts receivable. So this is received on 2/28, and the amount is $21. Carrying forward our assets, liabilities, and equity, you already see these numbers from the past, and we received cash of $21. Now the question is, how did we get this $21? Did we get it because we borrowed money? No. Did we get it because we made a new sale? No. Did we get it because owners contributed? No. So what could possibly allow this to balance out? Well, let's go over and get this here. The $21 account receivable is reduced. So we bring in cash of $21, and how does it stay in balance? Because we reduced an asset called account receivable, and that's why it's just an up and a down of assets on the same side, and these two are just totally unaffected. Moving on. As you know, when you run your business, you really should reconcile your bank statement on a regular basis. It helps you keep track of your cash balances. It can help you catch fraud if other people are working with your cash balances. And therefore, this bank statement comes in, and the balance on the bank statement as of February 28th is $301. Now, if we go back, you might look at this and say, well, why is it 301? And we will get to that here shortly. So it's 301, and this amount includes $1 of interest earned. Okay, so now, did we already talk about this $1 of interest earned? No, we didn't. We only discover this first when we get the bank statement. So this is new information for us, and we will have to record a transaction for that $1 of interest earned. Next, HSHC's check number 1 has not cleared the bank yet. So although on our books back here, we already reduced assets for the check that we wrote. You know, this in prior slides we already reduced assets for the check we wrote. The bank doesn't know that you ever wrote that check yet. So that's why that'll be important. This will be a reconciling difference between what the bank thinks you have as cash and what you believe you have as cash. Excuse me, that was a mistype there. It looked like it did say CHC, but it's actually a Lee Turf's deposit. Remember, they went and paid us for the hats that we sold, the 10 hats that we sold. So that check that they gave us, which we then deposited into our account, is actually in fact included in the 228 balance per the bank. So the bank has received that money, and it does show it in this $301. So then I'm going to ask you in QuickBooks to actually reconcile the bank statement. So that's our whole process. The whole idea is that you maybe have certain contributions from owners, you might borrow some money, you buy some inventory, you order some inventory, you then receive inventory, you then later pay for the inventory, you might sell some inventory, you might later receive payment for that inventory, you might earn some interest on your bank statement, and then you reconcile. So we won't be able to do a lot in QuickBooks, but I think that basic flow of transactions is very helpful, and if you can learn how to do that, you've got a good head start on how to use QuickBooks.